folks. It's Dave Burrows. I'm Chief Investment Officer at Barometer Capital Management. I've got Amit Joshi with me, one of our core portfolio managers today, and I want to welcome you to this week's Tuesday webcast. As usual, we want to sort of take a look at the market from the top down, take a look at what's been going on. There's been lots of certainly news flow over the last month. I always think it's interesting. You know, at the end of the day, it's more about how the market handles news than the news itself. You know, the market has 1,000 moving parts. News is part of it. But at the end of the day, we're investors and we own businesses. When a politician makes a comment about the broad economy, it doesn't necessarily change the underlying businesses we're invested in. It can impact sentiment for sure. But it's a good tell of the market's strength to see how well it absorbs news. So with that, just from the top, just let's take a quick run through asset classes and sectors and themes to see what's changing. When we take a look at the US stock market, you know, it's been working its way upward and to the right. This was the end of the bear market in January of last year. So we're about 13 months since the market made a new high. We're about 2 years and 3 months or 4 months since the market made its low in October. And when we get 2 years into a bull market without interruption, on average, the bull market's lasted over 5 years. So there's always concern when the market's making new highs as to whether or not we're about to have a correction. And effectively, since the market made its new high in the early part of 24, we've been working our way higher in a series of higher highs and higher lows. We talked over the last few weeks about this consolidation the market was having in the tightening range. And last week, it came up out of that range and made a new high. So that's the S&P 500, very constructive. Interesting, though. AAII, American Association of Individual Investors, percentage of bears. You would think we've been getting creamed in the market. The bearishness has been rising steadily since the fall of last year. So obviously there are things that people are worried about. The market's been able to shake it off. But it is telling when the market is strong and sentiment is not overly bullish. That's a positive sign. The market has to climb a wall of worry. When I look at the NASDAQ 100's actually lagged since July of this past year relative to the S&P. But similar to the S&P, was going through this tightening range from the early part of December. And last week, got up and out to make a new high. So very interesting to see markets make new highs against bad news. People perceive tariffs to be bad news, geopolitical wrangling going on over Ukraine, lots of uncertainty surrounding the new US administration. But frankly, I think it's remarkable how well the market is handling news. Now, it's not just the US. When we look around the world, global stocks are having a pretty good go. So we've talked a lot about Japan and the fact that Warren Buffett's been a buyer over the last 18 months. And as we always say, when you come out of a long period where the market hasn't made a new high, and eventually you do, it's probably the beginning of a new bull market. And so Japan had a couple of nice moves higher. We've consolidated over the last few months, but breadth is improving very nicely in the Japanese market, and in particular, the industrial companies and the financial services companies, they call them trading houses. But realistically, there have been some good gains to be had there. Taiwan is in a similar situation. India has corrected over the last 4 months, but in a nice uptrend above all the moving averages. Argentina, we've talked about, some Latin American countries leading due to some of the strength in basic materials and energy. But look at this. That's the Euro Stoxx 50, the 50 biggest companies in the Eurozone. That's kind of a big deal. Now, we broke out in the early part of 24, and we went sideways for about 10 months. But two very strong candles in January and February. Now, the Eurozone 50 is interesting because, again, lots of industrial companies and lots of financial services companies. So despite all the worry about what's going on, and this is investor sentiment, investor confidence, it's at a relatively low level. The Stoxx 300, or the 300 biggest companies, blasting off to make new highs. So again, it's what stocks are doing, not what we think they should be doing, that matters. When stocks are acting in a way that you don't expect, maybe it is that you're misunderstanding something. Well, I do think it's relevant that in the S&P, a great deal of the earnings growth came from financials this quarter. And that's not, just on its own. It's frankly happening around the world. So Euro Stoxx 50, what a great move. Now, this is all in context because global stocks relative to US stocks are as cheap as they've been in a very long time. S&P at 22 times earnings. Global multiples about 11 times earnings. Part of that has to do with the fact that in the NASDAQ 100 and the S&P, there's a lot of technology. 50% of the NASDAQ 100 is tech. And we know tech's been lagging a little. When we look down at Europe and a lot of the MSCI All World, very small percent of technology, but there's a lot of financials and there's a lot of industrials. When we look at what's going on around the world, this is as of Thursday of last week, the best performing markets of the world are not the US. Even China up 11%. The MSCI All World Index up 5.8%. And you got to move down the list into the third column here to get to the S&P. So, US stocks have dominated over the last few years. We've highlighted for the last 18 months, we think that global stocks can get going. And I looked at a bunch of the incumbent global funds that advisors are using and folks are investing in, and you'd be shocked. Almost every one of them is 70% US stocks. So they call them global funds, but they are global stocks funds with a lot of US stocks. So that's the Euro Stoxx 600, smaller cap, again making new highs, and corporate spreads making new lows, meaning bond investors are demanding less compensation to take corporate risk versus government risk. I think that's relevant. And also relevant, despite all the talk of tariffs, the TSX is making new highs. So it shouldn't be a surprise when you go a decade or 13 or 14 years without making new highs, and eventually you do, and you go through a global tightening cycle, and then central banks get looser. Assets are driven by liquidity, not news flow, and we've seen the TSX marching its way higher. Well, TSX is cheap relative to US stocks as well. So when we look at the TSX, part of the reason I think is financials make up such a big weight. It's by far the best performing part of the market over the last number of months. Energy 17%, industrials 12%, materials 11%, tech only 10%. And then the defensive sectors like healthcare and real estate and utilities, very small percentages, and they're underperforming, but it's not causing that much harm because frankly, they're small parts of the market. Even China is trying to wake up. Now, this is 2008. This is when it came back toward highs in 21. And of course, we know that they've had a very difficult time. But this is the month, and it was the month of October, where the Chinese authorities brought out the bazooka to stimulate. And it spiked higher. We've moved sideways for a couple of months, but some very important stocks in the Chinese market, and there's good ones and bad ones, are blasting off over the last couple of weeks, and I think that that's relevant. So I don't want to lose sight of the fact that when global stocks start to do a little better, it tends to go on for a while. So the All World Index since the beginning of last year, when we started our global fund, is up 20.9%. The global equity fund that we are running is 80 positions, 40 growth companies, 40 strong relative strength companies, 40 value companies. Is up just a snip under 43% since then. And really, you can see is picking up steam as global markets wake up. So we're really glad to have this as a diversifier in portfolios. We think it's going to be an important part played in the portfolio over the next several years. Because frankly, this is just beginning. MSCI All World Index versus the equally weighted S&P is put in a double bottom, but only just breaking trend. It goes back to 2010. So I think lots of room here, and we're looking in client portfolios to continue to bump this sort of from a 5% weight to a 10% weight. Moving on to fixed income, the bond market has been a very tricky place for people to be. We've been avoiding this now since 2020. 1981 through 2020, falling rates, rising rates, higher highs and higher lows since 2020, and really no sign that that's over with. The TLT, which is the long end of the US Treasury market, has been in negative returns now since 2020, and even with the coupon eking out a very low single-digit return. The thing that concerns me about the bond market is historically, after the initial rise in inflation, and these are all of the historical inflation cycles, after a moderating period, you get a second wave. And we think we're just starting into that. The last 3 months of CPI has come in hot. And so despite the fact that they're reducing short rates, long-term yields are staying high, stickily high. And I think that has an impact on things like real estate or companies that need debt in their financing model, which I go back to the comment. We had 40 years where the borrower was in control. We likely now have 25 to 30 years, the lender's in control. So we don't want to own companies that need to raise capital to grow. We want companies that generate cash. So from an asset class perspective, if I compare stocks versus bonds on a relative basis, stocks are clearly leading. Stocks are an inflation protection asset. You know, companies have the ability to raise prices, certainly the right ones do. Dividend growth stocks relative to bonds continues to make new highs. And so in our income portfolio, where we can be anywhere, we're highly focused in dividend growth stocks. And just to put a point on it, over the last 2.5 years, the aggregate bond index up 5.2%. The investment grade bond index, investment grade corporates up 8.9%. High yield bonds up 22%. They act most like equity. High dividend paying common stocks, as seen by the Dividend Aristocrats ETF, up 20.2%. The tactical income portfolio here, Barometer, up 36.8%. Dividend growth continues to carry the day. So look, we got to get returns. At the same time, we got to manage risk. There may be a time we got to get defensive. We will go to cash at times when things get difficult. We will play defense. But I don't think that right now is one of them. When we think about the risks, risk is not disinflation, which is what bonds protect you against. Risk is inflation. And all you have to do is look at this commodities chart to see it. Commodity prices fell to 2020. They had a first leg higher. We've been through the tightening cycle. And look, these are the last 6 months, commodity prices just marching higher. And it started with agricultural commodities and is working its way into others. So far, year to date, commodities are strong across the board. Gold in particular, continuing to work its way higher, now sitting about 43% above the 200-day moving average, 200-week moving average. And we know, historically speaking, each one of the big bull markets over the last several years got you to close to 80% above the moving average before you correct it. So we think that there's a long way to go here. Copper prices, after testing the rising moving average, have taken off over the last couple of months. And that makes sense because PMI data, the manufacturing activity data, is picking up. So if we compare commodities versus bonds, market's telling us we need inflation protection, not disinflation protection. So stocks and commodities. And then frankly, comparing commodities relative to the equal weight S&P is seeing a turn. So lots interesting going on, lots for us to focus on. We talked a little bit about the dollar a couple of weeks ago. We highlighted that in a crisis in 2015, in the Chinese growth crisis, the Canadian dollar bottomed out at 68.80 in a spike low that reversed quite quickly. We had a spike low in the beginning of COVID, March of 2020, which reversed quite quickly. And we had a spike low a couple of weeks ago on the talk of tariffs. So far, looks like it's trying to reverse here. So we may have seen a short-term low. We'll have to see, have to put some more time behind us. But I think this may have been quite an emotional low. So look, at the end of the day, we have to pick our spots. 70% of return comes from getting to the right neighborhood. Our top-down work helps us to identify pockets of the market that are seeing net inflows. And then we use our bottom-up work to try to identify specific securities that we can use to express our view within those themes. And we're looking for things that are good, getting better, where they're strong fundamentally to begin with, high-quality earnings statements and balance sheets, but where we can see something changing for the better and where we can see the technical factors being supportive. So ultimately, where we can find groups in the market that are seeing inflows and find securities we can use to express our view, that's where our portfolio should live. And then, of course, the last piece is if breadth starts to deteriorate, our job is to get more defensive. So we watch weekly all of the various sectors and themes for signs of deterioration to see where we need to get defensive. And I have no problem getting that way. When breadth deteriorates, we're going to raise a little cash. We stop putting new money to work. And ultimately, we stop putting on new positions. But that's not the situation we're in right now. Breadth in the US has been improving over the last few weeks. Breadth globally turned up this week. So some markets were strong, others were weaker. We're seeing an expansion of breadth, more markets participating, more stocks participating. Around the world, the percent of stocks trading above their 50-day moving averages have been improving. That's a great measure of short-term trend. Is it trading above the smoothed average of the last 50 days? And we've seen some mixed signals in some of the short-term indicators in the US, but the percent of stocks above the 150-day moving average also improving. So in general, breadth continues to be quite sound. But I just want to highlight, really only about 49% of stocks in the US stock market are participating in this rally. So that means you may not do as well as you can do by owning the entire market. 50% of stocks doing well, 50% of stocks not doing so well. We'd prefer to high grade in a list that are all technically sound. It's also an issue that the Magnificent Seven, as magnificent as they've been, are lagging the market so far year to date, and they're dragging down the index. So we think there's opportunity to be stock pickers this year. Let's talk leadership quickly. Financials just continue to lead the market. So really since the late part of 2022, financials have been leading. And they continue to lead. We're trading basically at new highs as of today. Relative strength has been rising steadily. And of course, the XLF ETF is a basket made up of banks, credit card companies, insurance companies, exchanges, all things financial. Frankly, European financials are now playing catch up. Look at this big move in relative strength versus the S&P. Companies like HSBC and Alliance, UBS, Zurich Insurance Group. So this is not purely a US phenomenon. There are issues around inflation and spreads around the world, things that we can take advantage of. And frankly, the Eurozone financials, as read by the EUFN, which is an ETF that owns Eurozone financials, just making new highs for the first time going back to 2013. So in Canada, we talk a lot about banks. We talk a lot about insurance companies. I've mentioned a number of times, Fairfax Financial is the #1 holding at Barometer and has been now for about 18 months, property and casualty company, keeps a pretty low profile. I've asked Amit to jump on with us today to talk a little bit about what's going on at Fairfax, why we like it so much, and frankly, why it's breaking out here to new highs.
Great. Hi, Dave. Thanks so much for having me on. Yeah, just to kind of kick it off on Fairfax. So as you mentioned, it's a insurance and investment conglomerate. Many times it's compared quite favorably to Berkshire Hathaway, which is led by Warren Buffett. A lot of similarities between the two businesses. So they're a P&C insurer and reinsurer, and also have a large investment portfolio that uses similar principles to Berkshire Hathaway in terms of value investing. Like you mentioned, Fairfax has been a long-standing position for us and one that's performed very well. And the reason we continue to like it is the operational excellence that Fairfax has shown and the underlying underwriting profitability of the insurance business itself. Not to mention the steady interest and dividend income that we see from the investment portfolio. Now the likes of about $2 billion per year that they see from interest and dividend income alone. So a lot of great visibility into earnings there.
Yeah, so
And
Amit, walk us through this chart and how we should read it.
definitely, yeah. So I think this is a really interesting chart. This comes from the folks at Scotiabank. And what this chart is doing, the gray bars at the bottom highlight the underwriting profitability of the insurance business, both reinsurance and insurance itself. And as you can see, that portion of the bar charts has been increasing and has been very steady, a steady increase. The red portion of the bars is the interest and dividends from their investment portfolio, which has also been growing and been very steady. And then the black portion is the share of profit in associate businesses. So these are more so their private investments that at times and in the past could be volatile. And that share, although it's growing, it's a smaller piece of the pie. So there's a lot more visibility and less volatility in the earnings of Fairfax itself, which ultimately should result in a higher multiple for the company. So that's one of the reasons that we continue to like it.
So now, Amit, the estimate for 225 is for a drop in the underwriting profit. And if you looked at that at first blush, you would say, well, okay, that's not a great thing. But give us the hidden message in that.
Yeah, that's a great point. And these are obviously analyst expectations. The one thing that I'd turn everyone's attention to, and we've all seen it in the news, is the heightened catastrophe losses that we've seen on the back of Hurricane Milton, Hurricane Helene, fires in Los Angeles. The insurance business is a very hard market. It's a tight market. These losses make it easier for the insurance companies to continue to raise pricing, given the amount of payouts that they continue to make on the back of these catastrophes. So we expect the market to continue to be hard, and we would continue to estimate that the underwriting profits would continue to be strong. And just an
So just
example.
I'm gonna stop you there just for a second because it may be lost on some folks what you mean by hard. A hard market in insurance means that it is a market where they can take price, where they can raise premiums. When there have been insurance-related claims, it gives insurance companies the opportunity to raise the premiums because they're well justified. And
Absolutely.
so having a blip in their underwriting profit gives them an opportunity to make more profit for several years in the future by raising premiums, which none of us like to see, which is why we like being invested here because it helps offset some of those, high auto insurance prices that we have. But
Correct.
we really do like the fact that the biggest and fastest growing portion are the investment returns that they get on the float. And that's really where Warren Buffett has been particularly successful in investing the float, and net of what he needs to pay out in the insurance claims, the rest go to the shareholders. And so having a predictable stream of interest and dividends coming in, very, very attractive, obviously. So,
Yeah.
Amit, do a quick comparison, Fairfax versus some of their peers.
Yeah, so this is another great chart, and you can see Fairfax in the red bar towards the end. They're growing their premiums from a smaller base, but if you look at the red diamond the CAGR growth that you're seeing is phenomenal and is at the
Read,
high end of the group.
read compound annual growth rate.
Correct. Yes. So it's the best in the group. And all the while that Fairfax continues to trade at a multiple that is a discount to their peers. So about a 14% discount to the likes of Berkshire Hathaway and Markel, which are, direct competitors to a Fairfax. While
Right.
they are putting up great numbers, the profitability on the insurance business, is has been quite remarkable. Even in this last quarter, they posted a combined ratio of 89%. Anything under 100% is profitable for an insurance company, and 89% would be best in class for the
Right. So
last
that means
few.
they're paying out less than 89% of the premiums they're taking in. Is that right?
Correct.
Yeah.
Yeah. Yeah. So expense management's been great. The underwriting of the business and from an insurance perspective has been great. And then we've had the steady dividend and interest income as well, which gives us
Right.
a lot of visibility in terms of earnings.
So nice stability in the earnings. It's a smaller company, so it can grow faster and is growing faster and trades at a discount to some of the peers. I like that, and it's just been a great quiet performer. Just while we're on it, Emmett, maybe just comment on TMX Group. Of course, we've talked about this one a bunch of times over the last year,
For sure.
but clearly it's been a good couple of weeks here. Maybe just go through a little bit about what's going on there.
Yeah, so another strong quarter here from TMX. As we've spoken about before, they're a multi-class integrated exchange group. They have subsidiaries that operate in cash and derivative markets and clearing houses. So trading of equities, fixed income, and commodities. I think one aspect of the business that is lost on folks and maybe wrongly they're painted as a volume business in terms of trading activity for the market. However, they are quite diversified. 50% of their revenue comes from recurring sources like market data, technology services, and clearing. So a lot of recurring revenue, a lot of good visibility in terms of the revenue. And that portion on a long-term goal for TMX is to grow that to about 2/3 of total revenue. So they have stability there from the recurring revenue. Trading business has been operating very, very well. And we could see a return of the IPO and secondary market, which is a big business for them as well.
Right.
Outside of that, they've been growing their derivatives business, which is a high margin business, and they've been expanding into private markets and global indexing through their Vetify acquisition. Just a glimpse of that from the last quarter, we saw that business growing at a 48% clip, which is pretty remarkable. And on the back of equity and trading growing about 12%. So strong business that's not completely reliant on trading volumes. Strong free cash flows, high margin business. They grow the dividend about a 9% compounded annual rate, which is fantastic and what we look from a dividend growth perspective.
Yeah. So, I look at this and I think to myself, it's hard to be too bearish on the market when the shares of the exchanges are going through the roof. And obviously, there's an expectation that we will see a big pickup in financing this year. And frankly, this is one of those companies that has the data. So where we look at a world of big data, these companies are going to be able to have continued opportunities to monetize the data. And I think that's quite interesting. Just financials as a whole, interestingly enough, continue to have a relatively small position in institutional portfolios. And we think that can grow over the next couple of years as well. So still early days, we think, in this financials bull market, and the group has been very, very resilient. And moving on, thanks very much, Ammon. I really appreciate it. Let's talk about industrials. Industrials have consolidated a little over the last month. Frankly, we've been very happy with our positions. European industrials have blasted off as well. So we're getting some confirmation in other parts of the world that have a lot of industrials exposure. The companies that we've been focused on, we've talked about Howmet a fair bit. They make, precision cast parts, in particular fan blades for jet engines. They reported their earnings. Obviously, market pretty happy, making absolute and relative highs. ERJ, which is Embraer, competitor to Boeing, and Airbus, is the number 3 aircraft manufacturer. There's There is some speculation that they may move into larger body jets, as a lot of airlines are looking for competition to Boeing and Airbus, performing really well. And our newest addition, Axon, which we added, I'm going to say 2 quarters ago. This is the company that makes tasers. Obviously, some money being spent on law enforcement. Their earnings due in 7 days, breaking out to new highs today and new relative highs. And newest addition, the portfolio, we got some eyebrows raised about Deere. Deere took off today, up 4%. Looks as though inventories are at trough levels at the dealers, which is very bullish. I don't think that that was expected. And they are having a very significant uptake in their precision ag equipment, which allows farmers to use GPS and AI in managing the load of fertilizer and seed and so on, to get more efficient use of their land. So another interesting industrial company. So industrials continue to move along. On the energy sector, if you look at the equally weighted basket of Canadian producers, it looks like we've been sort of trending sideways. Seasonally, we're into the time of year, mid-February through summer is the strongest period for crude. And we're looking pretty good with ARC Resources. Relative strength has been rising. Very large, long life producer of natural gas and working its way into the liquefied natural gas market. Suncor trading very close to highs, and relative strength moving higher. Dividend growth here looks really attractive. I think it looks like we could get dividend growth in the mid-teens over the next 3 to 4 years off a 4% dividend. And the infrastructure companies that are operating pipelines, look quite interesting and performing pretty well here too. Materials has been sort of dominated by golds, and I keep saying we're not gold bugs, and we're not. But when you're in a bull market, you got to take advantage of it. Agnico has been very, very strong. When I look at it, this has just been a great company. 5-year dividend growth of 24%. They got 11 mines. They produce 3.4 million ounces of gold at a cash cost of just around $900. They've raised their dividends, consistently. They've been paying dividends for over 40 years, and has outperformed the S&P, the gold index, and gold since 2005. We think we're early days in a new bull market here. Kinross, very similar. Alamos, very similar. And we added one more position over the last few weeks, and that's Wheaton Precious Metals. This is a more conservative company. It's a producer, but it's a royalty company. They get royalties off of 38 different agreements that they have provided financing to. In return, they get a royalty on the revenue that's produced, and they've been growing their dividend nicely as well. So these are all inflation protectors, we believe. Communications sector has been very, very strong. A lot of it has had to do with Meta. 21 days in a row was up. I think it was down today for the first day in 21 days. That's probably the most significant run of daily gains in the NASDAQ going back to the 1970s. Technology is continuing to meander. Broadcom has been a good one for us, trading better than 95% of companies in the S&P. It's really the only strong semi at this point. They're due to report in the next couple of weeks. And we did add some CrowdStrike, which is a cybersecurity company. You can see recently over the last couple of weeks finally took out the highs from June. And cybersecurity really has been the best part of technology over the last 6 months. So lots to do. I think it's really interesting when we look at earnings growth from the rest of the S&P over the last 3 quarters versus earnings growth from the Magnificent Seven. It does tell us that we need to be looking beyond tech, and that's why we've had a much lower tech weight. And the returns now coming from the market are lagging in Mag 7 versus what we're seeing in the broad-based indices. On the defensive assets, not much changing here. Utilities continuing to lag on a relative basis. REITs continuing to lag on a relative basis. Staples have bumped up a little over the last couple of weeks, but still, a long way from highs. Slowly working its way through moving averages. I don't think much to do there. And healthcare had a nice little bump, but backed off here over the last week. So when I look at it, breadth is getting better. The average sector, 41.6% of stocks and uptrends, up about 1% over the week. We're trying to focus in the sectors that have more stocks doing well rather than fewer. So we can see down at the right-hand side of the spectrum, regional banks, insurance companies, Wall Street, that's the capital markets banks, oil service. And the far left, there's some things that we have less exposure to. We're focusing on the stronger breadth groups. So what does it look like? This financials group continues to grow, partly because of organic returns and partly because, we've added to it on strength. Energy is about 16% of firm assets. It's about 4 times the S&P weight, but around the TSX weight. Industrials are an overweight. Materials are a significant overweight. And communications. Technology now down at 7%. Consumer staples at 5%. That's for the most part our position in Dollarama and Loblaws. Consumer discretionary about 5%, significant underweight. Healthcare 2% underweight. Real estate underweight. Utilities underweight. So not so much changing. And we keep focusing on the fact that we are in a liquidity cycle. Earnings came in pretty well so far on the quarter, up about 12%. It's the best quarter we've seen since the second quarter of 2022, and earnings expected to strengthen through the course of the year. Credit spreads are pretty benign, no sign of concern about credit here, and volatility continues to be right in the very low end of a typical range that we would be in a bull market. So we are making new highs, but I'm not concerned that we're in a situation where the market should correct. Sentiment is very reasonable. Positioning, I don't think, is out over the skis. In fact, a lot of hedge funds reduced exposure through the course of December and January, only to have to start putting it back on. I always like this data. We don't make decisions based on it, but I find it interesting. This is from my friend Ryan Dietrich. If you took all the years where the S&P was up 3% or more on Valentine's Day, what happened the rest of the year? Well, on average, the market was up 13.7% and up 93% of the occasions through to the end of the year. We don't know what's going to happen this year. We're up 4%. The average year is up 7.7%. So that would be close to double the average year. The fact that we have positive breadth readings and some very clear leadership gives us confidence in the portfolios as they are put together today. If things change, and undoubtedly at some point they will, we'll get more defensive. But that might be a year from now or 2 years from now. But when the time comes, we will get defensive. With that, if there's any questions, certainly happy to answer them, but we certainly appreciate you guys jumping on and spending the time with us on Tuesday afternoons. So let's just take a look and see what questions we got. Most analysts see only a 10% upside for high-flying gold stocks like Kinross, Agnico. Is it time to take profits or be hacked, exit these positions? Well, here's something that I've learned. When a sector's been out of favor for years, the analysts who cover the sector maybe didn't see the last bull market. We smile here sometimes because when a sector gets going, there's always the comment, well, it's a sell on valuation, take profits. And you'll watch analysts steadily ratchet their estimates higher and higher and higher. Because 2 things happen in a bull market. Earnings get better, but multiples expand. And by nature, that means the multiple that the company's trading at, the multiple of earnings, winds up looking expensive relative to the most recent number of years. Gold stocks are trading at almost record low cash flow multiples versus history. And that's because for a long period of time, people were very skeptical and very frustrated. Yeah, they moved up and they moved up nicely. But just remember that chart that I put up earlier. The GDX, or the basket of gold stocks, is trading 44% above the 200-day moving average. In previous bull markets, each leg went on until it was 80% over the 200-day moving average. That would be a 40% move higher from here. Now, we're not smart enough ever to pick the top, and that's why we use stop losses. If positions work out as we hope or expect, we will constantly ratchet the stop losses up and behind, and we'll never pick the top, but eventually we'll get stopped out. But I have found in general that bull markets can go on a lot longer than you think they should. And I think we are in the very early stages of a bull market in commodities. So, as they say, you never go broke taking a profit. But I never saw anybody get wealthy taking profit after you're up 15 or 20%. So we think that there's room for them to move higher. This is from an anonymous attendee. As a result of the Trump tariffs, some economists predict possible global recession because of a tit-for-tat tariff war between countries in the world economy. With this, I find it hard to remain bullish. How do you feel about this? Well, I'll just go back to what we talked about at the beginning. And we can all pull out these charts of all of the terrible, awful things that have happened over time, yet the market has continually worked its way higher. If you make decisions based on how you feel, you will not make money. Period. If you make decisions based on what you think the market should do, as opposed to what it is actually doing, again, it will be hard to make money. The hardest thing to do is to let your winners run. And it's hard to sit. There's always going to be things that are scary. You have to remember that the market is driven by lots of things. News is just one of them. The fact that earnings came in so much better this quarter than what was expected tells you likely we're going to see estimates get ratcheted higher. And if that's the case, and if business conditions remain strong, like employment, then it's likely, companies can continue to do very well. So we think that, there's things to worry about. I frankly think the biggest news, the biggest information that I'm getting out of the market currently is the market is as resilient as it is, despite the things that people are worried about. You can see the bearishness of investors, yet the market's making new highs. So, as they say, the market can stay irrational longer than you can stay solvent. I don't think the market's actually that irrational. I do think that it's very possible business conditions going forward will be more business friendly to corporations and investors than they have been over the last several years, where we saw record regulations put in place. So try not to focus on the news. Lawrence is asking, when would we look to add FFH or X? Well, we own them already, and we're going to hold them. I think the fact that FFH just came out of a base and is moving higher is quite positive if the sector continues to look good. We add to winning positions as we go along. And so I'm not sure I would be pushing lots into TMX right now. It's just had a big move over the last couple of weeks, but I don't expect really it's going to pull back very much. But yeah, these are positions that we'll continue to hold. Anonymous, I've heard rumblings about a commodity super cycle. You seem to be positive on commodities, but do you believe there will be a super cycle? What is a commodity super cycle? Well, I put it in different terms. I put it in the terms of a secular bull market. See if I can share my screen again. Okay, so let's do this. Let's use, I don't know, we'll use Cameco as an example. Let's look at the long-term picture. So I would suggest that this was a secular bull market, okay, a big cycle higher for commodities. You could call it a super cycle. This is a secular bear market. Market went nowhere from 2007 through 2023. And coming out of that, I think we have a long secular bull market. Now, some people will call it a super cycle. You could say we've been in a super cycle for US stocks since 2013 when they made the first new high in 13 years. I think that the way that we look at it is we've moved into an inflationary world, and that can go on for 25 or 30 years. And there will be several sort of legs of a bull market during that period, but we're in the very beginning. Most people I talk to are waiting for the genie to go right back in the bottle and inflation's going to go away as fast as it came. And I don't buy it. When you see these big generational shifts, they go on for a long time, and it takes years for many people to believe that it's happening. I've had a lot of discussion with clients and friends of the firm about the idea that commodities could have a long way to go in front of them. And it's not a popular opinion. It's certainly not a woke opinion. But we need these things. You can't build anything without commodities. And we're going to build a lot of stuff, I think, over the next few years as we see manufacturing reshore to the US, as we see AI demand a lot of more power generation. We're going to need a lot of materials to do all that. So I do think that we are into a structural bull market in commodities, and that's the way I call it. Stephen asks, the biggest holding of the income fund is the Barometer Music Fund. How is the Barometer Music Fund doing over the last few months? It's funny, I don't think to talk about the music fund on this webcast, even though, it's a very significant investment for us. Our music fund is now about $160 million of music copyrights that are cash generating assets. The music copyrights last the life of the last remaining artist plus 70 years. You're collecting digital pennies, but streaming is growing at just around 10% a year, which means the revenue pool keeps growing. The portfolio that we own is really quite gold-plated. I mean, we have virtually all of The Weeknd's music, Drake, Justin Bieber, the writers that we own their catalogs wrote songs for Taylor Swift and Dua Lipa, and really the biggest stars of the streaming era. The portfolio generated 9% cash last year. So US dollars distributions were around 9%, and that's growing each year. And the portfolio trades at about 12 times its cash flow. And the transactions that are being done by large private equity funds, they're paying 18 to 20 times cash flow. So we think when the fund runs its course, there's probably a 50% lift in value when we eventually sell the assets. So it's about a 10% weight in the income portfolio, and it was put there as an alternative source of income, and we're just really, really happy with how it's working out. And that's we do have that in a bunch of client accounts. It's not for everybody, but the nice thing about music is it's not economically sensitive. It's not cyclical. It's very predictable. When we buy the catalogs, we know exactly what we're buying, exactly what the history has been on the songs. Last question. Carol is asking if we are in a short slump for uranium, or is it time to increase exposure in the commodity? Well, I guess the first thing I would say is on if I were to look at, say, the URA, which is the basket of uranium producers, it looks similar to what's happened in copper. We came out, we went through the tightening cycle. It's above the moving averages. It's testing these short-term moving averages. I would say I have to give it the benefit of the doubt. We've got higher lows. If you take a look at, say, Cameco as an example, not too much to be bearish about there. You know, this was the low back in June of September of this past year. I don't know. I think I would be a buyer here. We own Cameco. If I look at the short-term chart, you know, there's sort of important support in around here. So my guess is it probably goes higher with the rest of commodities and energy, but it's sort of on the 1 yard line in the short run. Is there any more questions? I think we got them all. Now, folks, I really appreciate people tuning in. I hope that these are useful. If there's stuff that we haven't covered that you'd like us to, please reach out, send us a message, make a phone call. Happy to have a one-on-one conversation if you're too shy to ask on the webcast. And as we always say, like, we're in the business of growing our company. We've been working hard at building out our wealth planning services with some additions over the last while, and they're being really well received. And the portfolios are doing well, and we've got about 200 families that we get to take care of, and we'd like to continue to grow that. So thanks very much for taking the time. Bye, folks.